Every choice that you make has consequences, whether that be financial or otherwise. For example, if you're choosing a dessert and you have a choice between apple pie and a brownie and you choose the apple pie, you get the apple pie, but you're giving up the cost of having that brownie also. Join us as we discuss some opportunity costs that we see in the financial world and why it can really impact your savings.
Good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Jamie Burton.
We're happy to have you back. Folks, there are a lot of economic terms that you're going to see and feel and get exposed to the more you research. One of the common questions I get from people, especially younger people, are, Joe, what books can I start to read about understanding what's going on in the world? And my answer is not really many. There are some books that you can read that talk about economic theory, but most of what happens in the marketplace and the world happens so quickly that books become outdated. My book's going to come out later this year. It's called Retirement Runway. And I've done my best to be as basic about concepts with long wisdom that's in there, and then a video links that you can go to get updated stuff because things change continuously. One of those things that doesn't change is the notion of opportunity cost. And today, Jamie's in here with us. She is one of our senior advisors up in Lafayette, Indiana. And we're going to have her break down what opportunity cost is for you and some things that you really do need to consider. So, Jamie.
Yeah.
What's opportunity cost?
So opportunity cost is when you have different options and you choose one option, taking the benefit from that, but you're giving up the benefits that you could get from the other option. So it's the consequence that you have of choosing one thing over another, essentially.
What's the most common time that occurs?
The most common time in the financial world that we see that is, do I pay off debt or do I invest this money that I have? It's really a big struggle with people because a lot of times when families come in, one of the biggest things on their heart is, I don't want to have debt. It doesn't feel good to have debt. I don't like owing people money. I really just want to take this extra money that I have and pay it off. So that's when we kind of have to take a step back in those meetings and really get the details about what debt they have. Is it good debt or is it bad debt? What are the interest rates on the debt that they do have? And does it make sense to pay off a high interest loan, a high interest debt? Or do they really just have some low interest debt that they're hanging on to, whether it be their mortgage or a car loan? And it really makes sense to put the money elsewhere in investments. Mathematically, it equals out to where the investments are making more compared to what they're paying in debt, and that makes the most sense. So it's really just taking a step back with each person that comes in and breaking down what they have and what their opportunities are in the future with the money that they have.
So let's look at it because it really is about choices. Mm-hmm. It's trade-offs, right? Mm-hmm. So let's take the 5 critical elements and talk about that. So in your life after work, mm-hmm. right, that's the first part of it. People have the choice between taking an annuitization, a pension, if you will, mm-hmm. Versus taking money out of their 401k, mm-hmm. right? And so talk to me about that. How's that?
Yeah, so looking at their pension, we really need to look at does it make sense to turn that on? How much of a payout are they going to get based on the value that's in the pension? Is it going to be something that can cover their standard of living going forward? Does it make more sense on the investment side if their pension is only paying out a small percentage and they're making more on their 401k side? Which one does it really make sense to pull from?
So how would you talk to somebody about opportunity cost between an IRA and a Roth IRA?
Yeah, so that's a big one because of taxes and the benefits inside of IRAs and Roth IRAs. So we know that tax codes are going to change by December 31st of 2025, if not sooner. So if we're looking at somebody today that has an IRA and a Roth IRA, we want to make sure that the money that they are pulling out to live off of is coming out of their tax deferred money out of their IRA, at least up to the top of that 12% tax bracket before they're touching their Roth IRA money, because that Roth IRA money has so much benefit going forward, knowing that all of the earnings in there are tax-free, and when they pull it out, whenever they do decide to pull it out, they don't owe any taxes on it. So we want to make sure today the opportunity cost of paying as little as we can in taxes is there to allow that Roth to continue to grow.
All right. So again, it's all trade-offs. And I think I can assure you, if you walk into our office, we always have a filter that we make decisions through. Right. So I gave you the 5 critical elements a second ago, but I'll give you the fiduciary focus is what we call it. There's always 4 areas we're going to look in when we discuss opportunity cost, or what do you do with a dollar, right? And so the first one is risk and volatility, right? So do I want a reduced amount of volatility, so I'm going to put money in a bank, or do I want an increased probable return over a period of time, so I'm going to use a stock or an exchange traded fund, right? So that's one of those comparisons that you've got. The second are fees and expenses. Now, so I'm not a big fan of expenses. Expenses are things that are internal, that I'm not able to see, I'm not able to feel. Some people will tell you to pay no attention to them. John Bogle would tell you, the gentleman who built Vanguard would tell you the average mutual fund had more than 1.75% of expenses inside of it. I'm more of a fan of paying attention to the fees. I want to know what it is that I'm paying up front, right? And being able to control that. But there are places where you have a higher fee for likely a higher return over a period of time. It's not always true, but you want to pay attention to fees and expenses in any investment decision that you make. The third that Jamie just hit is taxes, but it's both taxes today and tomorrow. And none of us wants to pay more tax than they have to pay. But we want to pay the least amount of taxation over our financial journey. And remember, if 2 of you make it to age 60, actuaries will tell us there's a 90% probability that one of you actually makes it to 90. That's another 30 years of dealing with risk and volatility, fees and expenses, and now tax codes that change all of the time. Last but not least has been a quiet conversation. This said, I don't know, for the last 10 years, people kind of looked at me like, Clark, you've lost it. But the fourth part of the fiduciary focus is real return. And it's what we talk about when it comes to purchasing power and inflation risk. It's that you have $1,000 today, Jamie, and you have no money next year, right? Mm-hmm. And so the example that I always try to give people in opportunity cost, back when in 1980, I was not in the industry. I was in high school, right? But I was still playing around with a little bit of this stuff. But if you would have given me your $1 million in 1980, and you would have looked at me and said, Joe, don't lose it, right? And so I would have taken the $1 million and I would have put it in the bank because you were worried about volatility, mm-hmm. right? Put it in the bank. And back then, CDs actually paid 14% a year. So you got $140,000 income that's coming in every single year. Mm-hmm. 10 years later, I come back and I say, Jamie, I still got your $1 million. And you go, great job. I said, but there's a problem. CD rates are now 5.5%. And now your $140,000 income is $55,000. In 2000, I come back and say, did the job, right? Still have your $1 million 20 years later, except now it's down to 5%. In 2010, it was down to 1%, mm-hmm. right? In 2021, it's not much better, yes, right? 22, right. I guess I should say. Time flies when you're having fun. Yes. But here's the point. That is the biggest example of opportunity cost that I can give. People gave up understanding that there's more than just the short-term risk today, and it's mm-hmm. one of the decisions people make in annuities and all the time. Yeah. And so one of the big things that we are looking at when we look at opportunity costs is we're making sure to look through the 5 critical elements. So the first one being that your life after work. So like we were talking about earlier, Joe and I, does it make sense to pull from my IRA or my Roth IRA? Am I having the right amount of income taken out to make sure that I can have my life after work without running out of money? Then we have the taxes, which we also hit on. Are we making sure that we are paying the best way on our taxes, taking advantage of the tax code, making sure that we're not paying too much, but we're also not paying too little, knowing what we have coming up in the future. Then we look at your investment playbook. So when we're looking at our assets in how your portfolio is divided up, we have to make sure that you're not taking too little of risk based on the situation that you're in, giving up the opportunity of having those gains in the future. So we have to make sure that really the risk that we're taking and the allocation that we have in your portfolio makes sense for you, and you don't have this big opportunity cost that you're missing out on. Then we look at the good, bad, and ugly of life. Life happens. A lot of times, life insurance makes sense for people when they have young kids or they have a business that they need a continuity plan.
But then you have to have the discussion, what kind of insurance do I need? Do I need a term insurance policy? Do I need a whole life insurance policy? Do I need a variable insurance policy? And a lot of times it makes sense to do the term insurance because it's a lot cheaper than the whole life insurance. And if you got the whole life insurance, you'd be giving up the opportunity cost of those premiums that you're paying there, to where that money could be used better somewhere else. Lastly, you have the legacy planning. So we have to make sure that the way that your assets are set up makes sense for your beneficiaries going forward. Are we making sure that, because we know not all beneficiaries are equal, we have kids that we all love the same, but they might not be in the same income bracket. They may not be making the same amount of money, to where IRA money would be good for one person, but not as good for another of our loved ones. So we have to make sure that when we're looking at the legacy part of it also, that the opportunity costs there make sense.
Key thing is everything you say yes to requires at least one no.
Yeah.
Right? And
Yes.
and if you had to explain opportunity costs to a 5-year-old, that is probably the best way to explain it. If you say yes to this toy, you have to say no to that one.
Yes.
You used apple pie and a brownie, right?
Yep.
Paying off debt or investing, right? One or the other. If you go on vacation, it's something else you could have done with your money. You could have funded your Roth, right? I mean, it's all opportunity cost, and there's a whole lot more to life than just money. But what we want you to do is to be intentional about the things that you do. Have a filter that says, okay, here's how I'm going to make my decisions, and just stick to it, right? And so that when you do need to go off your diet and eat the brownie or the apple pie, you're prepared. You understand what's going on. There will be bumps in the road, ladies and gentlemen, but let's understand the opportunity costs that are out there. Go to our website, yourlifeafterwork.com. Get signed up for a Next Steps meeting, 800-928-4001. Ask for Brittany, Jamie, or Dean, or Aaron, or Grant. Somebody on our advisory team will sit down with you. We'll give you 90 minutes, things you should consider right now, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it in writing. 800-928-4001, yourlifeafterwork.com.